Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, I'm doing a Mea Culpa for 2022 and predictions for 2023. This is something that I've resisted doing over the years for a number of reasons, mostly because people in the financial media make a lot of money by engineering their content for maximum advertising dollars, and so they wind up making a lot of bombastic remarks about their predictions about what's going to happen in the future. And that stuff sells pretty well. If you've ever seen Jim Cramer's show, he's got all these bells and whistles, and he jumps around and slams on different buttons on his desk, and it makes for pretty good TV. But at the end of the day, I think it leads to pretty crummy investment outcomes. And for that reason, I haven't really covered that type of content on the podcast in the past. That being said, I'm asked constantly about my opinions about financial markets, the world economy, interest rates, inflation, stocks, bonds, the whole gamut of financial topics. And because of that, I thought it would be interesting in this episode to talk about a few soft predictions I had at the beginning of the year, more appropriately, maybe speculations I had about what would happen in the markets this year, and just comment on which wound up being correct and which didn't. Alongside that, I made a few predictions for next year. So I've got four main predictions of what I think will happen in the markets next year. My disclaimer here is that because we are all human beings and the markets are based on irrational behavior from other human beings, we should not run out and take these predictions as gospel, nor should we use them to make investment decisions for the coming year. But that being said, I do have some opinions on what I think will happen. We'll see how things turn out next year, but I thought it would be interesting since this is a question we're asked almost constantly. And I hope you enjoy it.
Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. So today on the show, this week on the show, I should say, we're going to do something a little bit different. We haven't had guest interviews on the show here in the last few weeks, not for any particular reason. There have just been other items that I've wanted to cover. But now that we're nearing the end of 2022, I'd like to have an episode where it's a mea culpa, personally, where I talk about some things that I thought were going to happen in the world and in the financial markets this year that I was flat wrong about or just didn't happen. Now, if you've listened to the show, if we've spoken directly in the past, you probably know I'm not in the business of making these bombastic predictions about what's going to happen in the financial markets or what level the S&P or the Dow is going to close at the end of the year. People in the media business do that. They're really good at it. They're really good at engineering content that attracts eyeballs and ears and people's attention by making these really bombastic remarks because that's the business they're in. They're trying to sell advertising either through their magazines or ads on TV or on their show, podcast, whatever it is. That's not what we do here. And because I think it often gets in the way of sound decision making, I actively refrain from making such calls. And I'm even reluctant to answer when asked and, by friends and family and in the community and that kind of stuff. That being said, there were some things that happened this year that I was right about. There were some things that happened this year that I was wrong about. At the end of the day, I've been doing this for long enough to where I know we do not want to make investment decisions based on my personal speculation about what's going to happen. Like anybody, I'm going to be right about as often as I'm wrong about this stuff. Now, I do follow the markets. I am a professional. I have a lot of education and experience to analyze companies and the markets and the economy, and I understand a lot about banking and all this. So yes, I would argue that I probably do know a lot more than the average bear on this stuff. But at the end of the day, the returns that we get on our investments are mostly fueled by human behavior. And because so much of that is out of our control, and it's human behavior by other human beings who are just as irrational creatures as we are roaming this planet, the better investment outcome is going to be reached by having a long-term approach, being consistent in your asset allocation, designing a portfolio for your needs, for cash flow and retirement and tax stuff and all across the board, and designing a portfolio that matches your life and your financial objectives as opposed to designing one for what you think is going to happen in the next 6 to 12 months. Because you're just as you're just as likely to shoot yourself in the foot as you are to actually add value. So, all that aside, I thought it might be fun to just talk about this because of that exact reason. I've been reluctant to make such calls in the past through blogging and through podcasting and in talking to people. I have had some opinions on what I thought might happen, and some of them turned out correct, some of them didn't turn out correct. But just to be totally candid, this is not something that we make strong investment decisions on. So, with that in mind, a couple things that I was right about this year, and how I'd like to structure the episode this week is just go through a few major themes as I look back on 2022. Here are the big things that I thought would happen. Here are the major things that did happen, and here's where I was right. Here's where I was wrong, and I'd like to make some predictions for 2023 on the same vein. Maybe depending on how this episode goes, we'll circle back to this and do something similar in December of 2023. So, number one thing that I thought was going to happen, I thought Bitcoin was going to be down in value. And this is one that I was correct on. If you think back 12 months, Bitcoin was trading around $60,000 a coin. It hadn't quite topped off yet. I think that happened maybe in January or February of this year, but it was going strong and looking like it was going to do well. And crypto in general, it just seemed like there are all these signs that pointed to the fact that it could have been a bubble. I think that maybe part of it was a bubble, but like I said last week, when talking about the FTX situation, there are so many legitimate use cases for this thing. I don't think crypto goes away entirely by any means, but the value of Bitcoin seemed a lot higher than it probably should have been. I didn't make an investment decision based on this, but that ended up being correct. As it was way overvalued, and it's really come back down in a big way. Now, again, just to be totally transparent about this, I don't think I ever went public with any of these calls. This one happened to be right. I don't think we made any big investment decisions, and every time that I've talked to anybody about this, I'm pretty sure that I've said I have absolutely no idea what's going to happen in Bitcoin. Seems pretty rich at this point, but it went down. So I didn't make a hard and fast call on that, but suspected that it would fall dramatically this year, and it did. Another thing that wound up being correct, international equities did better than their U.S. equity counterparts in 2022. So far in 2022. Got a couple weeks left. Now, in dollar terms, non-U.S. stocks did a little bit better than U.S. stocks. I've got some numbers here I'll share in just a second. With regard to, let me bring them up. I just lost them. So with regard to the U.S. broad market, what I looked at was the performance of SCHB, which is a Charles Schwab based index ETF that tracks the total U.S. stock market. Big companies, small companies, everything in between. That's down 17.5% on the year. SCHF, which is a similar index fund managed by Charles Schwab, but it tracks a group of non-U.S. companies in developed economies, was down 13.5%. SCHE, Charles Schwab-based index fund tracking emerging market companies, down by 16.5%. And the SCHE includes the portion of Russian holdings that basically went to zero earlier in the year when the market no longer became investable. It includes exposure to Chinese equities that have not done particularly well this year, if you may have heard about them. Nonetheless, both of those segments, both developed economies, companies in developed economies, and developing economies, both did a little bit better on a comparative basis than SCHB or the U.S. market broadly. Now, that's in dollar terms. If you think about it in their own country's terms, they did. The disparity was even wider. Yeah, you say, yeah, the U.S. just did a little bit worse this year, but that doesn't make up for the previous 10 years. You're right. The U.S. over the last, if we stretch the timeline out over the last 10 years, the U.S. has still done a lot better than international companies. But once you correct the 2022 performance and you strip out the performance of the dollar, the U.S. dollar has been really strong this year. Interest rates have gone up. It attracts a lot of international investments buying fixed income securities at higher interest rates. The US dollar has been a lot stronger. And that hurts the performance of non-US equities in dollar terms. Because if you take dollars and you go buy euros and you invest in a company in Europe somewhere, and then that company does great, and you take the money out and you convert the euros back into dollars, well, because the dollar has appreciated, you get fewer dollars per euro than you did at the beginning of the year. And because of that dollar appreciation, it's really eaten into a lot of um, international stock fund performances so far in the year, because so many of them will not hedge against the dollar, and you have to return those performances to U.S. dollar terms before you can really get the return that we see as investors. Long-winded way of saying that non-U.S. companies really trounced U.S. companies in their own currency terms, and after exchanging back to the dollar, they still did a little bit better, but not by quite as much. Another thing that is a trend that I think is going to continue, without getting too far into my predictions for this year, but I wound up being correct in 2022, and I think is going to continue. Value companies did better than growth. All stocks, by and large, most segments of stocks in the US were down by some measure in 2022. Another comparison, a couple of Schwab index funds, one of them SCHV, V like Victor, which is their index fund that tracks large cap value companies, is down by about 7% this year. Its counterpart, SCHG, at the other end of the spectrum, and I'll describe that here in a second, Schwab fund that tracks large cap U.S. growth companies, down by almost 29% on the year. Huge disparity there. And so for those of you who are wondering what this all means, value and growth kind of sit at two ends of the spectrum. They're a discrete way that a lot of professionals and a lot of investors across the world like to use to categorize equity investments. And on one end of the spectrum, you have value. Value tends to relate to longer term, more stable cash cow kinds of businesses. Procter & Gamble, Coca-Cola are two good examples of that. They've been around for a while. They produce steady cash flow. Oftentimes, the profits left over at the end of the year, some of the profits, that is, are distributed back to shareholders in the form of a dividend. And the reason is that management knows that they're not growing, they're not terribly innovative, they're not growing revenues at a high clip. And so if they take all those profits and they reinvest them back into the company, the shareholders are going to be relatively upset because Procter & Gamble, Coca-Cola, they're not doing anything terribly innovative. Investors could take the cash and go invest in something that's growing faster, which is why they have to issue dividends or repurchase shares, which has been kind of controversial over the last decade or so. At any rate, that's your value company. When you buy Procter & Gamble or Coke or any value company, you're not buying it because it's going to take over the world, grab market share through innovation, new business model, that kind of stuff. You're buying it because it's inexpensive. The earnings are inexpensive relative to what you get. That's a value play. On the other end of the spectrum, you have growth companies. Growth companies, think of Facebook, well, technically not Facebook anymore, but Amazon, Netflix, Google, a bunch of tech companies. They have innovative business models, products and services. They're growing market share rapidly. Because of that growth, any profits left over at the end of the year are typically reinvested back into the company to fuel that long-term growth, because that's what management wants to do. And they know they can sell it to shareholders, because if they keep up the growth rate, shareholders are not going to want to take anything out as a dividend. They're going to want to keep it back into the company for reinvestment. So that's the growth side of the equation. And when you buy a growth company, you're not buying it because it's inexpensive. And the way that we evaluate that is usually comparing the price at which the stock trades to the earnings that it produces, or the cash value, or the enterprise value, or some combination of those items. You're not buying the growth company because it's cheap. You're buying it because it's innovative, and it'll continue growing. Amazon has done phenomenally. It hasn't been cheap for a long time, but the thing has just continued to overpower its competitors and really expand worldwide in a number of different ways. AWS is just a massive um, entity in the business world and in the tech world these days, and it doesn't look like it's going to slow down anytime soon. So in economic expansions, growth companies tend to do well. Because think about why you're going to buy a growth stock. You're buying it because they're going to continue the innovation. They're going to continue the growth. So you're buying the story. When you're buying a value stock, you're not buying the story. You don't need a story. You're buying it because it's inexpensive. The earnings you get are inexpensive compared to the price at which you can pick them up for on the open market. And so when times are good and people are a little bit looser with their investors, are a little looser with their purse strings, when the economy is trending up, they're more willing to pay up for growth companies and drink the Kool-Aid and buy the story. But when the economy turns and things tighten up, interest rates might be going up either as a result of it or because of it. Borrowing costs are a little bit higher. People just tend to clench up. They're not willing to loosen the purse strings. They want more stability. They want cash flow. They want a dividend. And value companies tend to outperform in those periods. That's the period we're in right now. And as you might know, if you've listened to the show for a while, I'm an advocate for having an element of both in your portfolio, being broadly diversified, but maybe weighting your portfolio toward value and away from growth for stability. And coincidentally, because across multiple business cycles, when you factor all this stuff in a long-term period of time, value tends to do a little bit better, all things considered. So in 2022, value did better than growth by a substantial margin. And these are the periods in which value tends to catch up and do a little bit better. Look at where we're at in the economy right now. Interest rates seem like they're still going to go up. As I record this, the Fed has a big meeting later in the week where they're going to forecast a little bit more about what they plan to do next year. As it stands right now, we're in for more rate hikes. Maybe that tapers off, maybe not. We don't know. But inflation seems to be going down. The economy is, so the Fed basically has its foot on the brake and is tapping that brake every time they raise interest rates. And so the economy is tightening up and slowing down a little bit as a result here too. And in that environment, that's the time to be in growth stocks is to be in value stocks as opposed to growth. So again, back to the caveat here, back to my disclaimer at the beginning, that doesn't mean run out and abandon all your Amazon and all your growth stocks and buy only value stocks, right? We still want to be consistent long term. But hey, if you had to put a gun to my head, I would say value is probably going to do better next year than growth. But I'm not confident enough in that to make an investment decision accordingly. We want to continue that broad diversity and consistency in our portfolios. Now, here's where I was wrong. I thought inflation was going to be down by more than it has been. It started to creep down a little bit since the second half of the year, really. I thought it would be substantially lower than it has been, and I was wrong about that. My thought was that the inflationary pressures were somewhat short term. They were a direct result of the stimulus measures, and that our supply chain would persevere a little bit better than it has. Well, supply chain has suffered more than I thought it would. It's taken a lot longer to come back online. And the main area where I was wrong in all this is I thought that after COVID, we would swing back to a more normal environment a little bit quicker than we have. And the main reason we haven't is because our supply chain has, and what we've learned over the last couple of years, at least what I've learned over the last couple of years, is our supply chain is a lot more fickle and international than I would have guessed. There's a lot less stuff happening here in the U.S. being imported from other countries than I previously thought. And so with COVID shutting down a lot of those lines, with other geopolitical strife, with Russia invading Ukraine, those chains have really just broken down, and companies, both big and small, in the U.S. have had to figure out how to make their goods and services here domestically on U.S. soil again, where we kind of forgot how to do that in a number of ways over the last couple of decades because it's just been cheaper to offshore that stuff and import it from Thailand or the Philippines or anywhere else in the world. So this process is taking a little bit longer. It's making the goods more expensive, not only because there's a mismatch of supply and demand, which I'll get to in just a second, but because in general, labor is a little bit more expensive here in the US. And, if we're going to repatriate some of these activities, if you want to buy an iPhone that's made here solely in the US, it's simply going to cost you more than one that has a good number of its parts imported from China and other countries. And I picked on that one because Apple just announced that they're going to reduce their reliance on, I think, China specifically, and Foxconn, which is one of their big suppliers, just here in the last week or two for risk management reasons. So one reason that inflation has stuck around longer than personally I thought it would is that it's taken longer to rebuild the supply chain than I thought. We were a little bit more international than I presumed initially. But the other reason is that there's just still been a mismatch of supply and demand. Inflation, a lot of people I think are mistaken in thinking that inflation exists anytime there's a lot of money in the system. If we put more money into the banking system, that's always going to result in inflation, and that's not true. It doesn't have to happen. That's not necessarily going to happen. What is true is that when there's more demand for goods and services than there is supply of goods and services, that's when we get inflation. And the Bureau of Labor Statistics can break that down into labor and wages. The Fed likes to study inflation impact across a whole bunch of different goods and services. We've talked about the CPI and how they measure inflation broadly. So you can break it down into individual categories. But that's what's more relevant. And so when we have more money in the system and there's more money in your bank account and my bank account, we're more likely to go out and buy new TVs and other goods and services that we might want. So there is a correlation there, but it's not a necessity. And so we have a supply chain that's coming back online slowly. The clog at the ports, I believe, is still there, but it's been minimized by a lot as we've worked through all these shipping containers that have been waiting months in the, off the shore of Long Beach to come into port and offload. They've been able to redirect a lot of that traffic to San Francisco and Oakland and up and down the West Coast, basically. So the supply chain issues are coming back online slowly. But also with interest rates coming up, mortgage costs are going up, gas prices have been up, and even though there's a lot of money in the system as a result of COVID stimulus, there is less money in a lot of people's pockets. And so I thought that we would see less inflation. Well, it hasn't slowed down by quite the pace that I thought. It started to tick down a little bit just means that the Fed will have to be a little bit more aggressive. Now, is this going to result in a soft landing next year or beyond? I really have no idea. A lot of the Wall Street banks have predicted that there's like a 1 in 3 chance that the Fed is able to navigate this successfully and avoid a severe recession, and a 2 in 3 chance that they'll be forced to raise rates to get in front of inflation in a way that does drive us into recession. I haven't looked into that and analyzed it enough to really have a strong opinion either way. I like to think that they're really good at their jobs, but they're playing a delicate game and are actively trying to talk it down as much as they can. And again, talking down inflation means that they're trying to communicate in a way that sets our expectations that inflation's a little bit lower than it might be, because it becomes a self-fulfilling prophecy. If you and I think that inflation will be really high and the price of groceries is going to go up 100% over the next 2 weeks, we're going to rush to the grocery store and try to buy a whole lot more groceries and stock our freezer before the prices go up. And that demand, that increased demand in the aggregate, makes inflation kind of a self-fulfilling prophecy, and you find yourself in an inflationary environment as a result. So part of the Fed's job is to talk this down. And yes, they're as transparent as they can be, but they're trying to use media and communications to avoid those kinds of situations. So there's the mea culpa for 2022. A couple suspicions that wound up being true. One that I was wrong about. As far as 2023, I do think that inflation is going to continue going down. And so I'll go on record, quote unquote, and say that the inflation numbers that we get in Q3 of 2023 are going to be substantially less than they are now. I'm going to go out on a limb and say they're under 6% per year by then. Could be right, could be wrong. I'm not making an investment decision as a result of that because a lot of it is speculation. And again, I know I'm repeating myself, but it's because it's important. The best long-term investment outcome will be reached by being consistent and not running out and adjusting your portfolio based on my predictions for next year. Next year, because I don't see the economic environment turning around in the next 12 months dramatically, I think that value is going to outperform growth, both in the US and non-US again. I think that, now here's a little bit different prediction. I think that with regard to the cryptocurrency situation we're in the next 6 months, we're going to see another big firm or stablecoin go to zero and go under. There's not any transparency or disclosure surrounding the assets that are backing these stablecoins, which is a cryptocurrency that is pegged, quote unquote, to the value of the US dollar. Well, the value of the US dollar fluctuates, and the reason that any stable coin or any other currency peg, any foreign currency peg to the US dollar, the only reason that can exist is because there are sufficient assets backing that stable coin to where the operators can go in and buy and sell securities to match the value of the dollar on the open market. And we don't have any disclosure, any transparency from an audited source surrounding the assets backing these stable coins on the market. We already had one go under, Luna, earlier in the year. We had FTX go under. I think we're going to have another one go under, or either a stable coin or a big trading firm similar to FTX. I also think, this is the final one that the final prediction for this year, there's a lot of interest rate risk in bonds in 2022. Bonds did not do well because interest rates rose. If you're someone who's concerned about that, just hang on to the bonds you have. You will get your money back as long as the companies that have borrowed money through the bond offering are able and willing to pay back credit holders. And so as long as you don't have a whole bunch of credit risk in your bond portfolio, you'll be fine. You'll get your money back. You just need to wait around a little bit. I think that this coming year in 2023, so another way of putting that is in 2022, interest rate risk in bonds was far more important than credit risk. Junk bonds, bonds of not not as great credit quality, or a little less stable corporations, those who might not have the same capacity or willingness to repay bondholders later on. A junk bond is issued by a company like that, and because they're a little bit more risky, they have to pay investors more in interest to borrow money through the bond markets. Well, in 2022, the economy is largely still pretty good. There haven't been any issues in junk bonds yet, but when the economy turns in any business cycle, the junk bonds are the ones at the most risk, because by design, those are the bonds you're less likely to get your money back on, because the underlying companies paying you back are they don't have the same stability on their balance sheet or their operations. So in 2022, the story was interest rate risk. Interest rate risk was far more important than credit risk. In 2023, I think the reverse is going to be true. Credit risk is going to be important again. Interest rate risk will be far less important than it was in 2022. Again, same disclaimer. I probably wouldn't run out and make a big investment change based on this, but that's my speculation based on where we're at in the economy. So there we go. That's the mea culpa for this year. Part of the reason that I wanted to do this is I do get asked constantly about my thoughts on this stuff. I do have opinions and thoughts on all of it. But I'm also in the business of getting people to the best investment outcome for them. And because of that, I do not make investment decisions based on this speculation. And because I didn't really make any formal announcements or predictions last year, it was a little bit of a mea culpa, but I didn't really formalize or broadcast those thoughts and speculations and predictions last year anyway. So, take that for what it's worth. But I'm on record now with these four. I think value is going to do a lot better than growth. I think that credit risk is going to be important, again, more important than interest rate risk next year. I think inflation falls below 6% at an annual clip by the second half of next year, and we're going to see another crypto disaster, either through a stable coin or some kind of trading firm. So, hope this was interesting. Hope everybody has a great week, and I'll talk to you again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.